Welcome to Talk Tickers, where we dig into the earnings calls moving the markets. Today, we're tackling West Bancorp, ticker EWBC. And honestly, this one's a real head-scratcher. They just reported their Q4 2025 numbers, and on paper, it looked fantastic. But the stock immediately sold off. So what did Wall Street see that the C-suite might have overlooked? Let's get into it.
All right, so here's the mystery in a nutshell. On the one hand, you have a solid beat. Adjusted earnings per share, $2.52, just edging out the $2.50 estimate. Revenue, same story, coming in at $758 million when the street was looking for $746 million. You see that and you think, great, stock's gonna pop. But nope, the stock immediately dropped 2% in after-hours trading. So what gives? That's the puzzle we're gonna solve today.
To figure this out, you have to look at the two competing stories here. First up, let's hear from management. From their point of view, the message was simple, it was confident, and it was just overwhelmingly positive.
Yeah, the chairman and CEO, Dominic Ng, came out swinging on the earnings call. He basically framed 2025 in one way and one way only, as a record-shattering year. He ticked off all the all-time highs. We're talking revenue, net interest income, fees, earnings per share, loans, and deposits. The tone was pure victory lap, a celebration of, just really stellar execution.
And this right here really shows you the engine behind that success. What you're looking at is pretty much the gold standard for a well-managed bank, balanced growth. They grew their loan portfolio by almost 6%. And, crucially, they funded that by growing their deposits by just over 6%. See, this isn't just growth for the sake of it. It's stable, it's sustainable, and it's exactly the kind of healthy foundation investors love to see. And then, to really put a cherry on top of this record year, management drops a massive 33% hike to the quarterly dividend. Now look, this is way more than just a nice thank you to shareholders. A move this bold is a huge signal of confidence from the board. It screams, we believe our financial position is rock solid, and we fully expect the good times to keep rolling.
Okay, so everything sounds amazing, right? A record year, huge dividend boost. But this is where the story takes a sharp turn. Because the market heard all the celebration about 2025, kind of nodded, and then looked straight past it to the guidance for 2026. And what it saw there, it did not like. You can boil down the market's entire pessimistic reaction to just two words: margin pressure. If you're new to analyzing banks, it's a simple concept. It's that feeling of being squeezed. It's what happens when the money a bank has to spend, its costs, starts to grow faster than the money it brings in from making loans. And that idea became the big, flashing warning sign after everyone dug into the guidance. And here it is. This slide is the smoking gun. You don't need to be a Wall Street quant to see the problem here. The bank is guiding for their core profit engine, net interest income, to grow somewhere between 5 and 7%. Okay, not bad. But then they guide for operating expenses to grow between 7 and 9%. When your costs are projected to grow faster than your income, that is a crystal clear red flag for profitability. It's just simple math.
But wait, there's more. That wasn't the only headwind on the horizon. Management also sent a clear signal that the recent period of incredibly low loan losses, well, that's probably over. The market heard normalization of credit costs, which is really just a polite way of saying they expect to write off a lot more bad loans next year. And here's what that looks like in numbers. In 2025, their net charge-offs were just 11 basis points, which is fantastic, super low. But for 2026, they're guiding for that to jump to between 20 and 30 basis points. Now, to be clear, their overall asset quality is still really strong, but this guidance implies their credit costs could more than double, which, you guessed it, takes another direct bite out of that bottom line. So we're left with this crucial split. We have two totally different narratives playing out. In one corner, you have the amazing, record-setting performance of 2025, and in the other, you have this much more cautious, frankly worrying outlook for 2026. So how on earth do you put those two together and make a call?
And that really brings us to the core question for anyone looking at this stock right now. Given the super strong track record but the cloudy forecast ahead, what's the verdict? Are you a bull, focused on that proven performance? Or are you a bear, worried about these pressures that are building up?
Here at Talk Tickers, after weighing everything, our rating is market perform. What does that mean? It means we think the stock is pretty much fairly valued at the moment. The obvious positives from their great 2025 are being almost perfectly canceled out by the headwinds they've guided to in 2026. We just don't see a clear reason for it to dramatically outperform or underperform its peers anytime soon.
And this table just lays our entire thesis out perfectly. The bull case, it's all built on real, tangible, past achievements, that record 2025, the huge dividend bump, and their rock-solid capital levels. The bear case, though, is entirely about the future. That margin pressure we talked about, rising expenses, and higher credit costs. The market's negative reaction tells you everything you need to know. Right now, investors are giving a lot more weight to what's coming than to what just happened.
So, let's play this out. If our thesis is that the stock is likely to be stuck in a range, just kind of treading water while these forces battle it out, how would you trade that? What would a hedge fund analyst pitch?
Well, an idea that fits perfectly is a covered call strategy. It really aligns with that market perform rating. So the thesis, step 1, is that the stock's probably going to trade sideways for a while. The strategy then, step 2, is to own the stock but sell call options against it. And the target, step 3, is to collect that option premium as income. You're basically creating your own yield, getting paid to wait until the fog around 2026 finally starts to clear.
And of course, we always have to say it, this is not financial advice. Thanks for tuning in to Talk Tickers.